You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup Larsen, are excited to be back with this week's edition of the Systematic Investor series, which is our weekly ongoing and very raw exploration of the world of rule-based investing, and of course, where we also take some of your questions. As usual, let me start by saying good morning, well, actually good afternoon to you, Moritz, and good morning to you, Jerry.
Good afternoon, Niels. Good morning, Jerry.
Good morning.
As you can tell already, I'm not in my usual setting. The noise or the sound here is a little bit different, and of course, so we'll see how it goes, but hopefully it'll be okay.
Well, I'm really happy about the 3-hour late start. It's 11 o'clock here, not 8 o'clock. And maybe, I know I'm usually very quiet and reserved, so I'm more awake now, so get ready.
Great.
Well, that sounds exciting. Well, I mean, another kind of interesting week oil markets for sure. Some movements on the commodities, some of the grains I saw did okay, some of the softs did okay, and then of course we had kind of flattish US stock markets and kind of weak European stock markets. So we'll see how all of that turned out in our various portfolios. And of course, Moritz, as we do, our little tradition, maybe we start out to hear how you saw the week in Trendland.
Sure, happy to do that. Thanks, Niels. Week has been flat. So, I mentioned earlier, this year has been off to a wrong-footed start, so to say, losing money pretty much every week. And it's nagging me in a way. It's been a flat week. Quite some good gains from the bond markets. So long bonds, long the US dollar against most of the other currencies. That has been good as well. Lost money in the energies. I had some position change in the equities as we had a kind of like recovery in January from the correction in the fall of last year. Now that has turned around in the past week. I've been a bit more long, so lost money in the equities. So summing it up, a flat week and still down, obviously, for the year.
Okay, fair enough. Somewhat of a different picture, I have to admit, on our side. I was looking through the portfolio this morning. We trade 54 markets, and actually 45 markets made money last week. So we had a strong week on our side. Like you, fixed income, certainly one of the biggest contributors. Extraordinary given the low levels of interest,
Yes.
because it's certainly European bonds doing well. The Australian bonds did okay for us as well.
Mm-hmm.
Not so much in the US, really. And then we had generally positive contribution from equities, mainly European ones and Asian ones from the weaker equity markets we had last week in that region of the world. Not much movement in the US equity markets in terms of performance. And then, of course, the US dollar, stronger dollar. We're happy with that. So that helped as well. And then a few generally small pluses in commodities, but the commodity winner, so to speak, was wheat on our side. So all of those things did well. Theme-wise, I would say the only difference maybe is we're seeing some of the equity markets now actually turning long again, after dipping short for a while in December and early January. But we're seeing sort of a selected few. Still overall, I would say short biased in our portfolio, but a few things happening on that. So good week for us, and we're slightly up for the year now, which we haven't actually been able to say since February of last year. So that's a nice change. What about you, Jerry? We're always excited to hear what happens in single stock land. But of course, you may have also had a completely different experience in terms of the other markets that Moritz and I were talking about.
Yes, we're heavily committed to long dollar, so that's nice. I guess Sweden set a new low, and in that trade, cattle keeps going. That's relatively new, big uptrend. Cattle, palladium keeps going. That's nice.
Yeah. Biggest winner, by the way, of the markets I follow, with a 5% move last week.
Quiet in the single stock world. My 37 stocks are mostly long, small long, net long, but nothing crazy, nothing really going on there. So pretty quiet and not a lot of broad movements. I'm sure we didn't have a huge percentage of winning markets last week.
Sure. All right. Well, let's. There's quite a few things to talk about today. Actually, on one hand, we have quite a few questions coming up. But I also know there was, a bit of activity on the Twitter side, So why don't we just jump into that, Jerry, and see what you picked up this week?
A lot of interest this week, and one of the biggest was I retweeted an article, a tweet from Top Traders Roundtable with Lowe and Waxman and Kastrup Larsen. And I quoted both guests. Got a lot of interest. I think we keep learning the same lesson, and that lesson is that when liquidity drives up, all correlations go to 1. I think that was Saul and then Andrew Lowe. I think there are a lot of lessons from the financial crisis, but the real question is who actually took those lessons to heart. So I think, I'm not sure why people thought it was interesting. I guess everyone sort of has their own reasons, but that was a great interview and I really enjoyed it.
Yeah, they were both definitely on form during the conversation. I think you're right. I think one of the things that I liked about the quote from Andrew Lowe about who took on any of these lessons was for people who want to dive into it, they should listen to the interview because he actually goes through some of the various constituencies in our industry and talks a little bit about whether he thought they had learned anything or not. So I like those quotes as well, for sure. And in general, I mean, they're both super interesting people to listen to. So thanks for tweeting about that.
There's another interesting article, Seth Klarman interview, and the part that I liked the most was how important it is to have great clients. It's probably more important than any factor in enabling a manager to take a long-term time frame when the world is putting so much pressure on short-term results. At the worst possible moment when your fund is down, you need to have clients who will actually love most of the time, if not all of the time, to add rather than subtract capital. I think that's definitely, the biggest takeaway from the Turtle experiment, the Turtle program, was how important it is to performance when the client adds money when you lose, and they love your strategy and understand your strategy enough to know that the bottom line is following the rules. I've actually had clients tell me that recently when I try to explain performance. Just be quiet. I don't want to hear it. Just tell me you're still doing this, all the trades you're supposed to do, and you're following this system. And that's exactly the way it was in the Turtle program. The first big drawdown, they added capital, 50% capital to our accounts in the spring of 1984. So just growing up in that kind of environment where doing the right thing, do the trades, that's how we'll grade you. And sort of, now you get into the real world, and that's not how clients react most of the time. I did have one other client who was very similar to that. So that's obviously, they got a lot of love from a lot of people who have clients who don't behave that way.
I can recommend the article. You shared it, Jerry. Thanks for that. I read it yesterday evening. Enjoyed it a lot. It's an interview with Jason Zweig, I think, and such a great character, I believe. Lots of wisdom in there of treating clients fairly, not gaming them, not overcharging them. All of you've said is absolutely right. Have a good relationship with your clients is probably one of the most important things when you run that business.
And I think it's a point that is probably still very undervalued by the people who set up businesses, because very often what happens, I guess, in our industry is that it's the guy with the idea or the model or the rules that sets up the business. And so, of course, there's a lot of attention about, how good are your rules, how good is your system, et cetera, et cetera. But I think you're absolutely right, Jerry, from that article. I mean, it is critical to have great clients in order to make that business successful. And actually also in order for the investors to be truly successful as investors in trend following. Clearly people who understand that and tends to maybe add through drawdowns, they may well end up compounding at a slightly higher rate than even the original track record shows. So, I mean, that's super important. And I think the other thing it kind of alludes to is this thing about when you talk to clients, and that is whether you're making, as a manager, whether we are making the best decisions or whether we're making the most accurate decisions in our models, right? Because I think there's a lot of misconception perhaps where people look at our track record. We may have a big down month and they may say, well, that didn't look very smart. I mean, why did your model make those decisions? But then when you analyze the market behavior, then it's clear that the models are making the accurate decisions based on the data available at the time. So it's not so much about making the best decisions. It's about, people sometimes confuse that with the outcome of those decisions our models are making, because a down month might be a bad outcome, but it still may be the right or most accurate decisions we should be making as trend followers.
That's right. And it has nothing to do with education. If they just understood, if we just educated them better. No. It's a fundamental misalignment of how you're going to handle bad periods, and how do you treat all of your managers, and do you understand that this is an odds-based and long-term game, and people just get they get emotional, or they get under too much pressure, they buy into CTA strategies that they're not committed to. So it's really a shame. The client has to do their part in order for it to work, because our part is doing all of the trades, which is mandatory for it to work. And if we get cut off or money redeemed, then that too is another way of not doing the trades. You're gone. You've paid the price of all the losers, and you didn't hang around for the winners.
Absolutely. I think it's very important. And I think the other thing is that go ahead, Moritz.
Say that I found was really important, which he said in the article, is to prevent the drawdown that gets you into paralysis, right? So if you're down 30, 40, I think that's the number that he used, then he would say that he's probably paralyzed and his clients would freak out. And then that kind of like that bondage, that relationship starts to fall apart. So I got the feeling that he's extremely focused on preserving the capital net and not running it into that 30, 40% drawdown, which, is great, but maybe he has, I don't want to quote unquote advantage there. If, we follow our rules, we follow our trading system, we may get down there and we still need to follow the rules. For us, it would be the worst thing to do would then be to abandon the rules and no longer follow them. But our rules may actually get us down to that point. And he was, I think, very often saying that is something that must never happen to him because of him then just being, stuck.
Yeah. And I think the other thing, I agree, very often with you, of course, Jerry, and I think today is no exception, meaning not only do clients have to do their part, but I think also what we have to recognize that we all have biases. And, investors, I think, are a little bit disadvantaged to some extent because they have to kind of analyze and embrace a lot of different types of strategies in order to build these kind of very diversified type portfolios. And and I think it's only human to have some kind of biases towards some of the strategies. And I do feel that there is, more often than not, biases that often make investors more skeptical from the starting point, in order to fully embrace the explanations we give as managers in terms of why they need to look at our performance in a certain way, and maybe not judge us exactly the same as they might judge other types of strategies. This thing about, our job is to follow certain rules, and if we do that, we're actually doing a good job. The outcome might not be so good from time to time, but our job is, we don't control the performance. We control whether we do the trades, we control the risk we take, and so on and so forth. And as long as we keep doing that, we're actually doing our job. But I sometimes you come across people who, and maybe certainly in the news and the media, where they don't quite seem to get that point. So I'm glad you brought that up, Jerry. That's great. What else happened in the social media world?
Well, we enjoyed a nice roundtable discussion from a magazine, I think, called Hedge Nordic, CTA
That's right.
Roundtable late last year. I enjoyed it. This one tweet that sort of coincides with another article that I believe we all saw, that I don't think I tweeted, but it was along the lines of clients preferring incentive fee structures, zero and something, zero management fees or low management fees, and mostly incentive fees. And this sort of ties in with it. The quote is, "The CTA approach is often the result of years of research, and we believe that means significant better risk-adjusted returns. Some are saying we wouldn't mind paying a little bit more to get something that we think is better." And I think, especially if it's maybe incentive fee only, that seems to make people feel better. Although I think that it's very difficult to pay less. You'll definitely pay more incentive fee only when the performance is as expected. So to some degree, you're kind of, I love this CTA, I want to invest in them, but I'm going to choose 0 in 15 versus 1 in 10 or 1 in 5 because, well, I really believe it, and I really believe it's going to be great, but I'd rather pay more, essentially. So if you put it into a spreadsheet, it's very difficult to not pay more if it's incentive fee only. But if it makes you feel better, okay, whatever. But 1 in 0 or 150 basis points in a CTA mutual fund is a darn good bargain compared to almost any incentive fee.
That's true. I mean, that's absolutely true. I mean, I think you can find many flat fee funds where as you say, if I understand you correctly, Jerry, you say if the manager actually performs as expected, it's cheaper to buy the flat fee. The problem I have, and that's certainly not reference to some of our peers, in where you have great strategies being offered at very reasonable cost for one reason or another. But my main concern has been with these. Let's just put them under the umbrella of banks and big asset managers who didn't really believe in trend following up until a few years ago, when they could kind of come out with it in a different, dress it up in a different way, and suddenly they called it, but it's a factor, and this factor is momentum, and we can do that very cheaply for you. So that's the part I don't like about when you see these people offering something that looks like trend following. But I think it's a cheap version of it, and therefore, of course, it should be cheap. But I'm not sure investors can really tell the difference. What you bring up is interesting, because one of the things that's happened in the industry the last few years, at least among pension funds, is this concept of paying 1 or 30. And this was something that also came up in a roundtable I did in Miami with Texas Teachers Retirement System and also Florida State Board, so 2 massive pension funds. And I think Texas Teachers has been part of developing this with Allborn, the consultant, I think they coined this new payment structure where essentially the manager gets a 1% management fee, but it's also a payment against potentially a 30% performance fee, but not both. You get one or the other.
That was my original fee structure in 1988.
Wow.
one or 20. So you get the one
Wow.
or 0 and 20. And so, yeah, it's a great fee structure. I love that. But it would be more, I think maybe 1 in 15, maybe now, or so 1 in 10, but maybe that has even come down. But that's a great fee structure.
Yeah. So in a sense, it's nice to see that the pension fund, because on one hand, if I'm sort of maybe, this is just my view, but I do like to see the manager actually having some incentive to do well, to keep innovating, to improve the strategy. I think some of these banks who roll out, these replicators, there's really no incentive for them to do well other than to do well in asset gathering. Performance-wise, they're not incentivized to do that. And I know in some products, you have to go with the flat fee. And so I understand this is not necessarily, something you can apply across. But I do think it's nice when there is some alignment, like you mentioned there, in 1 or 20 or 1 or 30 or whatever. But
it is important, especially I think the asset gathering part of what you just said. If you have a manager like yourselves with just an incentive fee, that means the manager is only incentivized and interested in raising assets if that manager believes that he can actually make money with those assets. If that wouldn't be true, there wouldn't be an incentive to actually raise them. Whereas that just, if you have a flat fee structure, that coin flips. You're being paid for raising the assets. And I don't believe that that's in the interest and that pays a service to the client base.
Yeah. I know there were a lot more tweets coming from the CTA forum that Cameron put together along with his team back in, I think it was recorded back in November of last year. So we should keep that in mind when we comment on some of the things they said. But it was a great conversation. So I think you have more.
Yeah, here's another one. This year we saw far too many players trading the same trends. Trends appearing more quickly and sharply, everybody jumping in the same signal. When true value appears, we tend to see a sharper snapback. Have we seen that in the data? Until this year, not at all. I didn't like that one as much. Not sure it's correct. 2 people liked it. So,
right.
I think I'd just like to see the data. It's pretty easy. Have we never seen at all a snapback, a monster, ridiculous snapback all the time? We've all lived through natural gas multiple times. Oh my gracious. Swiss franc. Since 1984, it's been some very uncomfortable snapbacks. But anyways, it's all in the data. It's easy to talk about it. All you need to do is put some trades in a spreadsheet or do a little back test and run some statistics. And we just haven't had enough trends. I don't know which ones we had a lot more. It wouldn't matter so much with the few snapbacks.
Yeah, I think that, again, as managers, we always, we're kind of encouraged to come up with explanations when tough times comes along, like last year. And so these are kind of the easy headlines. But I agree with you. I don't think that it's accurate to say that this has never happened before. What may not have happened so often, and this is purely from memory, but I do remember discussing it on our side when we saw the initial correction back in February of last year, January, February of last year, of the equity markets. What seemed a little bit, and maybe it's just because everything had been in an uptrend for a long time, et cetera, but what seemed a little bit unusual was that you had new all-time highs, straight from new all-time highs, you went into a kind of a quick, not that deep, but deep, relatively speaking, to the last few years, correction. But that doesn't, account for a whole year's performance or anything like that. So I agree with you, Jerry, that I think it's a little bit easy to say that this has never happened before. I'm sure it has, and those markets you mentioned are, very good examples of these things happening. Sort of V-shaped recoveries are not unusual at all. In fact, I think March 09 in equities was a pretty V-shaped recovery. One day marked the low, and from there it went straight up. So, what about you, Moritz? Yeah, any view on that?
Absolutely agree with Jerry. I mean, the list and the number of markets with sharp snapbacks and reversals to me is kind of like endless. I have that graveyard of them. It's lean hogs, gasoline. I mean, pretty much all of the markets. So I just, when they say it hasn't been in the data, I don't agree with that. It's certainly in my data.
Yeah.
One of the most important things, if, maybe he was talking about stocks, but that's why it's just so important to trade so many different stocks and try to get as much diversification by choosing individual stocks, because you can just bring up charts, and some of the stocks, when they snap back and they have a big downtrend or a crash in like October, some are in downtrends already. Some we got flat. Some the longs, they suffered, and some snapped back to being long again, and continuing on the uptrend, and some turn into flats and shorts. So diversification is mandatory to try to minimize some of the unfortunate, and then improving your system.
Look at the stock of Tesla right now. Not that I'm trading it. I'm not sure if you trade it, Jerry, but I mean, that's kind of like every day is a snapback, one way or the other.
Right. And another good quote from that, it was my favorite probably, from that roundtable is, under the increasing pressure from lack of performance, there is a human tendency to tweak the model to satisfy requests for change. Managers can become victims of emotions and then get fooled by short-term randomness in the underlying data. So, maybe not changing the systems quick enough and realizing that we should improve and change and evolve, but you can also do the opposite, get emotional, change too quickly. Clients are complaining, employees are complaining, you're complaining, and we've got to do something. Let me see how are you going to handle this? And we do the back test, we see what happens. I think overweighting recent performance in the data in determining how you're going to trade is just a tremendous mistake. It's unfortunate that I don't think the world works that way. I wish we could rely more on recent data. The world is changing. There's computers, there's AI, there's machine learning. There's so many changes. Let's just overweight the past few years, and we're on our way. I'm not sure that is the answer.
So I have a comment on that, but I also have a question for you guys. So we heard that a lot, in particular after February of last year, where the whole industry got caught from the reversals, and so did we, and we got a lot of questions about, well, what are you going to change so that this doesn't happen again? And our answer, obviously along the line as you alluded to, Jerry, I mean, the answer is always, we're not going to change anything to handle a short-term event if it damages the long-term, projected performance, of course. So that's the thing. But I wanted to ask you guys, just out of curiosity, if you think about major changes to your strategy system, how many of those have you really made, say, in the last 10 years or so?
Very few.
Yeah.
I just wanted to bring this up. I think, Jerry, you also tweeted, and I probably also tweeted it. There's a person called John Gall, the author of a book called The Systems Bible. And I purchased the book. I didn't know it existed. Amazon Prime, thank you. Got here within, the next day I had it. It's not really about trading. It's, systems theory in general, like, the system of a production line and all that. But a lot of the things in that book, I haven't read it completely, but a lot of the things, they relate very closely to what we do. So what that person says is, what we reiterate all the time on that podcast is, a loose fit is better. It's more robust. It, keeps you in the game for the long run. And one of the things that was really great, I think, is that every system, it says like every system must start out as a simple system. It needs to have that clean and pure idea, needs to work on a simple basis. If it then starts to, and I will answer your question, Niels, if it then starts to evolve and develop over time and becomes more complex, and it still works, then the added complexity is kind of like a good thing. But if you start out with complexity, you're very, very unlikely to have a system that will work from the get-go. So, and it's, I didn't know that book, but to answer your question about the major changes, I'm extremely careful and considerate about changing, making, forced, brutal, tough changes, meaningful changes to the system, systems, changes that would maybe change its character. It's just never going to happen. I don't want to do that. I want to stay true to what I've developed back in the day. It is, based on a very simple premise, trend following. Well, very simple enough, I'd say. And, that fundamental thing must never change. I will never touch it. I will work around the edges, try to find better ways, maybe diversify the exits, trade more markets, do a few things here and there. But the major changes, to answer your question, in the even last 10 years, nah, nothing I would really say is super, super major.
Sure. What about you, Jerry?
Well, I think just continuing to be committed to diversifying when possible. It's a slow process, but
sure.
Over the years, when I first started, we traded 20 markets. That's a lot more than 20 now. And so that's having that commitment built in is important. Longer term, probably the most fundamental change was in the late 90s, early 2000s, just extending our look back period. And then that hasn't changed. So I think things like that are, that's probably pretty much about it. Maybe one other thing, but yeah, that's a great, beautiful benefit of trend following is that the system works. It's not going to work unless it's trend. That's the bulk of what you're banking on. So you don't have a lot to change or think about changing except stopping with the trend following. And that doesn't seem to be the correct answer.
No, and of course we're completely in line with you. I would say less than a handful of changes in the last 15 years or so, and but I'm not so sure that people necessarily realize the value of that kind of information, because to me at least it truly goes to the robustness of the underlying thesis of what we all do. The fact that with all the changes we've seen in the world and in the world of finance and the markets that have come on, the technology, high frequency trading and all those new strategies that weren't there, and of course people talking about there's too many people doing trend following and so on and so forth. But with all that change, yet the three of us sit here and say, well, actually we haven't had to make too many changes in 10, 15, 20 years, and still it continues to work. And I truly believe that is a testament to the underlying, strategy. But I think it's an underappreciated fact. But anyways, thanks for sharing that, guys. Anything else we should talk about from Twitterland, but also maybe from the article, any other topics?
I have a lot of stuff. We can save some for next week.
Sure.
I don't always make sure that people understand I'm being sarcastic and I'm making fun of things, that I tweet. So you got to figure it out for yourself sometime. But this one I thought was pretty funny about Bridgewater. Quote, she then shared the secret sauce to the sustained outperformance of the world's biggest hedge fund, radical transparency, videotaping every conversation for review later, constant evaluation of peers. It's kind of a family atmosphere. I thought that was really funny. And I do think my family has been like that some. Now, and we repented and said we were never going to be like that again. And yet that's what they ascribe to their success, videotaping and constant evaluation. Kind of funny.
Did you see it live, Moritz? So in Miami, I missed it in Miami, but I know that's probably where it came from, the interview there at Context.
Yeah, I saw parts of it, not all of it. I met the person quoting it on that day later on. Very interesting.
Oh yeah, sure, you did. You're on the A-list, of course. I forgot about that.
Well, I don't want to say that, but maybe you have to be lucky once in a while.
That's true.
But yeah, they have that going. That's how they work. Surely not for everyone.
Sure. Any other sarcastic tweets, or maybe not so sarcastic? Who knows?
Well, there's a few, but I guess we should end with the most popular of the week was a quote from one of my heroes, and probably the first time I heard about trend following in the early 80s. I was, in a public accounting.
Oh, yeah.
Martin Zweig was kind of a famous Wall Street guy on Wall Street Week, and I just never met anybody or heard of anybody who was quite as humble as he was, and sort of technically oriented. And he wrote books and had a newsletter, and I was subscribed to the newsletter, and it was about trend and sort of sentiment, contrary opinion. And so I sort of wrote all of that in my retweet about how he was my hero. I met him one time in New York, and I actually bought all of the historical newsletters that he ever put out. I just called up his firm and said, "Hey, can I buy all of the newsletters?" And they're like, "Yeah, you're really weird, but sure, we'll send them to you for whatever." So I have them somewhere for some reason, and he sort of his complete package of the type of person he was, and he's sort of credited for calling the crash of '87, which I don't think is exactly true. That video of him on Wall Street Week being very nervous prior to the '87 crash is out there, so you can judge for yourself. But great guy. And so his quote that got the most interest this week that I retweeted was, "I'm a trend follower, not a trend fighter. I'm smart enough to realize that a slap is easier to recover from than a beating." That's pretty good. I like it.
Yeah.
Bingo.
Yeah.
It's hard to separate the parts of trend following that are between making money and protecting capital. And I think from our point of view, probably for people who've been in the business, it doesn't always look like it, because our choice of leverage can overwhelm our claims of diversification and taking small losses and protecting capital. Because if we trade so large and have multiple, frequently double-digit up months and down months, plus 10, minus 15 and stuff like that, it makes it hard to follow the systems, makes it hard to like it, and it's hard to keep clients, and it's hard to sort of convince people, well, we're really taking small losses. So, but I think this is sort of getting to the heart of it, for all of us who want to have a long-term business and do this job for a long time. Is it is all about taking the small losses and diversifying and longs and shorts and taking slaps and putting ourselves in a situation where we can make money if there are long-term trends, if there are mega trends, outlier trends. And essentially we are preserving, capital, even though it doesn't always look like it. And I think that's what he's sort of saying here. It's very important.
Absolutely. Yeah, absolutely. Great quote. Well, why don't we turn our attention to some of the questions? We have quite a few. I hope we can go through all of them this week. So let's just jump into it. First of all, thanks very much for all the questions, and keep them coming. Just email them to info@toptradersunplugged.com, and we'll do our very best to answer those questions the following week when we do the recording. So appreciate it. First question is from Craig. And it's about portfolio allocation to different markets. And I'm just going to try and find the place where the actual question comes. It goes something like this. We all know about the benefits of diversification and that trends can essentially happen anywhere. However, portfolio allocation to various markets, equities, bonds, commodities, forex, seem to be one of those areas which has a wide range of implications from CTA to CTA. Besides fund capacity or markets liquidity, is it truly optimal to have equal weighting to each market sector, brackets, or sub-market sector? Put another way, should all markets really be considered equal from a trend-following perspective, or should empirical evidence to be taken into account? From my own empirical research, I found trend-following strategies on single stocks and commodities easier to apply than on forex, for example. But perhaps this could be unique to the time frame I mainly operate in, which is 2 weeks to 3 months for winning trades. Great question, Craig. I know, Jerry, you're going to be loving the reference to single stocks. So why don't we start with you? What do you think about how to treat markets? Do we treat them equal or not?
I think yes and no. So I think you definitely look at the empirical results and understand that some of the markets that are available in the futures are highly correlated to each other, heating oil, crude, and unleaded. So I would take that into consideration. My heating oil plus crude plus unleaded position is about the same as my cotton position. So something like that. Or you could just say, I'm just going to trade crude and cotton. I'm not going to trade heating oil and unleaded. They're sort of correlated. So, but if you want to avail yourself of all the different markets, they do have different chart patterns. When you overlay trend following system on top of it, the crude, heating oil, unleaded correlation will be less than if it was just a buy and hold. So yes and no, you definitely want to pay attention to the correlations, but split up the markets into to take into consideration that that they are correlated, but they are slightly different as well.
What about you, Moritz? Do you want to have a different view?
No, pretty much the same view as you would expect. It's important to have as many independent, say, moving objects in your portfolio as you possibly can. So like that, just as Jerry said, if you have, heating oil and crude, then probably have some overlap there. They're highly correlated markets, and you may not want to trade both of them, or if you trade both, then maybe you want to split the risk. The same goes for gold and silver. There's a couple of other ones that kind of like relate to each other. But in terms of treating markets the same way, yes, I'm a fan of that. If I were to look back and kind of like make a call on which markets to trade based on historical performance, I'd be very heavily overweight on essentially trading a long neutral bond trend following system that would probably win and just look beautifully. Now that is just, that is yesterday's news. It doesn't mean that it's going to play out in exactly the same way in the future. So I do want to have all those markets in there, regardless of their recent performance. And I want to focus on them being independent and behaving different from one another over time. And then I just treat them the same way, build up the portfolio and give it a go. I just, I cannot sit here today and say that, for the next 10 years, bond markets are going to be, again, the best trend following markets in terms of P&L, even though, this year seems like it again. But I don't know what tomorrow is going to bring.
Very true. I mean, completely agree with both of you. And I think to answer your question, Craig, one of the basic philosophies within trend following is a quote. I think that it was Larry Hite who coined it. I know Alex Grayserman has used it certainly subsequently. And it's this thing, knowing what you don't know. And I think that really has to underscore everything we do in terms of how we, create our models, the fact that we don't pinpoint one single time frame, and therefore we don't want to pinpoint anything specifically really in the approach. And that goes to markets as well. I mean, there's no, we shouldn't be guessing because it would be a guess about which market would be doing well in the future because we have no idea of knowing it. And therefore treating markets equal, I'm a fan of that as well. We do it on our side. And I agree with Jerry, of course, your sector allocation, you can consider it. But I think it also is about common sense. I mean, have a fully diversified portfolio, but don't overweight it completely in just because you have more markets in one sector. Have a bit of common sense. And then do your testing. See how it all seems to fit together. So, but great question. Thanks for that. Next question is from Johannes. And it goes like this. I have created myself a profitable strategy for trading, which could also be implemented into investment decisions. I make many intraday trades and have a good track record. Drawdowns occur maybe once a month or quarter and are not significant. So my question is, are there funds or CTAs, etc., who make investments for a very short period of time? Basically, is there any way I could scale successful intraday trading into a large-scale business for outside investors? Or if my wishes are to scale up, should I focus on purely conventional investing. I'm happy to go first on this one, Johannes, mainly because I've interviewed, and I know Jerry and Moritz, have obviously talked to many of our peers as well. But some of the interviews I've done have been with short-term managers, and of course, it's possible. I think there's a couple of things to think about when you do short-term. I do think, of course, size will be an issue at some point, meaning longer-term trend following strategy should, all things being equal, be able to manage more money over time. But I don't think it's going to be an issue when you think about whether you would be successful or not from doing this. There's plenty of liquidity in the short-term space as well. However, I do think some of the challenges in the short-term space is coming up with something that doesn't compete too much against people with big pockets like the high-frequency managers and some of the very large managers in the short-term space, because then it becomes, I think, hard to build something that is gives you sustainable alpha over time or outperformance on a small scale. And actually, it's something we look at internally on our side as well, and that is, can we find something in the short-term space that can be scaled? So far, we haven't really found anything we feel can be scaled, but doesn't mean other people can't. I certainly met people who are managing, hundreds of millions of dollars or even $1 billion in the short-term space. Of course, it's possible, but it really depends on the market you trade and how frequent your trades are. But, great question. Anything to add, Jerry, Moritz? What would you suggest?
It's possible to do. I think it brings a technology aspect with it in order to do it successfully. There are a handful of successful managers out there that have been able to scale up their business, just like you said, Niels, to over $1 billion, trading shorter term systems, some of them intraday, some of them like 1 to 3 day holding periods. But, I know them, and speaking to them, I know that they're very, very heavy on the technology side, much more heavy than we are as long-term trend followers. And just like, to put a number out there, there's a guy I spoke to just this past week, their annual cost, transaction costs, slippage, clearing, all that type of stuff is 30%, 30.
Yeah.
30%. So you have to have a real good system to come out ahead. So that's just one of the things to keep in mind there.
Obviously I would discourage that, but short-term trading, but I think it's fun also to, even though we are different and alternative to some people, it is kind of fun to participate in major moves in the markets and, be able to kind of have a process in a system that is sort of real world. I'm being short crude at 90 in 2014 and it goes to 20 something. That's fun. That's good. It's kind of cool. It's in the news. People are talking about it. The CTA's crushed it. That's good. Now, a short-term trader may have made lots more money than I did being short at 90 and then getting out at 25, But it's just kind of long, short, a million times in between. But I don't know, this disconnect with reality and what's going on in the world makes it less fun for me.
I think that's a great point. And the other thing, this is something that... and I think, Moritz, you're absolutely right. I mean, technology, and I've certainly spoken with managers as well, where they, their starting point in terms of slippage and cost is just enormous. So keeping up with that and ending the year with a net positive return for the client is really hard work. But here's another thing, something that I certainly would consider as well, and that is just quality of life. Because we as trend followers, we essentially design systems that, all things being equal, you could run spending maybe an hour a day to run your system, implement, put in the orders, and off you go. I'm not suggesting that if you were running it as a professional business, that you could just turn up in the office for an hour a day and investors would be happy with that. I'm not suggesting that, but I'm thinking of this as, if you as an individual, which is what I think you are at this point in stage, Johannes, if you want to design the perfect life, why would you want to sit in front of the screen all day doing short-term trading? I don't see that as the perfect life, frankly. So doing what Jerry has done, doing what Moritz has done, doing what what Don has done. Designing systems that essentially doesn't require a lot of work in terms of the day-to-day side of things, and which if you didn't have external clients, or if you have understanding external clients that fully embrace the fact that you're doing this so you can have more free time. Because I've come across a lot of managers who don't spend all their day in the office, yet the performance is absolutely good. I mean, there's no doubt about it. So I think that's another aspect you should think about, Johannes, before you decide what kind of strategy you want to run. I mean, take that into account. Time is one thing we don't get more of, so we should make the most of it.
Absolutely.
Good stuff. Now, the next question, guys, and by the way, I want to say this to the listeners. Usually, very often, Jerry and Moritz, they don't know the questions in advance. Not because I don't want to share it with them, but just because they can come into my mailbox and we just talk about it. And it's meant, these conversations, I'm sure, if you've listened to them, before, it's pretty free flowing, and we want to keep it like that, very casual conversation. But this question I had to send to them in advance because it's very detailed. It comes from Manuel, so thanks, Manuel, for this question. And I can't even read all of it. It's quite long and detailed, but I'm going to try and paraphrase it a little bit, and I would like to hear Moritz and you, Jerry, talk about it, because I think it's more up your street than it is our street, so to speak. But I think the question is, if you have a trade and you're using, say, a breakout system, and you're using some kind of stop level initially, in this case, average true range as an example, and you buy your quantity, and essentially at the point of entry you have a 1% risk for that position to your stop, and then the market starts going in your favor. And of course, if the market moves up, at some point you might have 2% risk if you haven't moved your stop. So I think what Manuel is trying to find out is, what are some of the good rules for managing the size of the position or managing the risk? Do we manage the stop price? Do we manage the size of the position in order to keep, the position in some, or the risk at some reasonable level? I think it's an interesting question, so I'd love to hear your views about it.
It is a really long question. We've mentioned a couple of times on this show that we don't like the daily vol controlling. I know that is not exactly what that question is about, but it relates to that. So I'm just explaining again, or like alluding to what I'm doing. If I've entered a long position and that market starts moving in my direction, then, well, first of all, that's a good thing. I like to see that. It may mean that I may have more risk on, depending on how fast that move is, compared to the initial risk which I had when I entered the trade. Now, I can be very liberal, more liberal with open trade equity compared to capital. Right, I have to be extremely strict on the capital, on the money that I have, must prevent that from going down all too much. But in terms of the open trade equity, I actually don't mind a little bit more risk all too much. So I'm not playing around with the position size there. The risk may increase a bit, but I'm not like reducing the size of that position in order to get it back in line with my original risk target, only because the trade has started to make money for me. I actually like to see that. There's one instance where, and really that is the only instance where I go in and change my position size, and this is just me doing it that way, but if I have a runaway market, so I enter a trade, and that trade just, rockets. It just moves extremely fast, produces P&L extremely quickly, and therefore increases my risk. So it just gets a great distance to my stop. If that happens in as rapid as I just explained it, like over just a couple of days, right after the entry of that trade, I will reduce that position a little bit. I will not get out of the trade. I will not do a counter trade trading system. None of that. I will definitely stay long. It just won't be as long as I have been. But other than that, not playing around. That's not what I do. I'm not changing the position size.
How about you, Jerry? How do you tackle this?
So I would use different words and definitions. So what I'm going to do is put the trade on at the entry place and then set the stop loss to 4, 6, whatever ATR loss, which is going to yield a 50 basis point loss, or a 25 basis point loss. So that's my risk. So I'm never going to use that word again. That's the risk. If it goes against me by some ATRs, I'm going to cap that, put my equation together in Excel, and it's going to yield a 50 basis point loss or 30 basis point loss, whatever. So then if the trade turns into keeps going higher, though, in my natural trailing stop, my second exit, the trailing stop, different from the stop loss, if that now is higher than the stop loss, then the stop loss is now out of the question. It's not going to impact me at all. So as the trade goes and makes profit and stays above my trailing stop, the vol can do what it needs to, double, triple, quadruple, 10x, whatever. My risk is not increased because my risk was the risk of loss of capital. But my volatility is increased. My standard deviation is increased. So I think I don't want to think about this increased volatility as increased risk. Although I do agree totally that at some point when the trade is larger and we've been in the trade for a long time and the volatility is really large and it's just got everything in the world going for it, like natural gas, let's say. We weren't in it very long, but it was a mega profit, pretty decent profit, and the volatility was skyrocketing. There's certainly nothing wrong with taking some of that off the table, reducing that. But I think his fundamental problem was equating the stop loss, which is there to preserve capital, and then the trailing stop. There's a second exit, the trailing stop. So I'm going to be so concerned. My concern level is at 10. It's maximum. Not going to lose more than 50 basis points. But if it's a profit, oh my gracious, I'll let that thing retrace hundreds of basis points. I'll let it turn into a loss and eventually lose the 50 basis points if the trailing stop hasn't moved up. So I think that is more of a traditional, old school trend following approach, which I really like, but I'm not against tweaking that in similar ways that Moritz mentioned.
Yeah, no, I think both questions are absolutely perfect, and I think that is the way to answer it. We don't use stops on our side, Manuel, so I think the answers you just got from Jerry and Moritz are absolutely perfect, and I think they're exactly how you should be thinking about it. So appreciate the question.
I would prefer a system that didn't use stop losses. I don't really know that they're that necessary. When I do the back testing, they don't seem to be that critical. So if you only have a trailing stop, that's far better than constantly trying to prevent the market and the open trade equity to sort of like do its thing and let it turn into a mega profit.
Yeah, no, absolutely. And then we have a question from our dear friend George. George has more of an allocator style question. He says here, you've all said you want 50-60 markets / return drivers for optimal diversification in a robust trend following system. Ray Dalio's Holy Grail says the marginal benefit of adding uncorrelated return streams starts to drop significantly around 15. Would you comment on why trend following seems to require so many more market return drivers? Let me just, before I read the second question, George, let me just quickly answer that. I think there's a bit of a difference here. I don't think Ray Dalio says, I'm only going to trade 15 markets. He's talking about return drivers. And as Jerry just alluded to earlier in our conversation, you can trade 3 energy markets, but essentially it's probably only one return driver. So I think that's where the 50-60 markets come from, often mentioned by us and our peers as a well-diversified portfolio. But if you strip it down to the 10 sectors it might represent, and maybe there's a couple of subsectors we can add to it, then you probably end up with, around 15 return drivers. That's kind of how I see it. But I'm going to go on to question number 2. It's just otherwise I might forget my own answers. I'm going to go on to the next question, then Jerry and Moritz there. they're much smarter than me, so they can answer both questions without having to remember your own answer. It says, you've all say you want 50-60 market return drivers for optimal diversification. You've also said it is wise to trade multiple parameter sets per market return driver. For simplicity for this question, I will say multiple equals 3. You further said the risk per trade should be in the 50 basis points range. Perhaps this math doesn't probably convey how it actually works. And then he does some math saying, you have 50 markets, 3 parameter sets that equals 150 basis points, and then you have 75 markets or 50 markets, so you could end up losing 75%. While highly improbable, using this logic, it appears if things went really wrong, a trend-following system could, in theory, lose 75% at once. If this is wrong, please explain. If this is right, please explain why you're not concerned. So, 2 questions. Jerry, Moritz, who wants to tackle these first?
Happy to do it. On the number of markets, the point with the 15 markets is that mathematically, if you looked at things, the marginal benefit of adding more markets after the 15th market isn't 0. It just decays. It becomes smaller. Now that may be true, but my thinking about the portfolio is a different one. I like to have as many markets as possible, as long as they behave in independent ways. And we've mentioned a couple of times on that show that even in our experience trading those systems, the year may depend on just one market, right? It may depend on just crude oil in 2014-15. And if you didn't have that market in, then it wouldn't be a good year for you. So the more markets I trade, then statistically, the greater the likelihood that I will be able to participate in one of those markets that will make a good year for me. So I like it. I like many little risks, as many as possible. And like I said, the benefit of adding another market that is not correlated by +1 is not 0. It just becomes smaller, but it's still a benefit. So let's go after those benefits. And it's not difficult to do. So therefore, I like it. On the second question, I like the question, but I think my answer to that is relatively simple. If I had 3 parameter sets, and if I wanted to risk, say, an initial 60 basis points on a certain market, then each of those 3 parameters would have a 20 basis point risk. So I would just, split it down and have each parameter, I regard that as a subsystem, and those have then 20 basis points of risk. And if you sum it all up, it's again the 60. I wouldn't risk 60 on each parameter. That would be too much.
Yeah.
I think his final question there, yes. Can your trend following system lose all that money in a go? I mean, remember, we're long and short. Most of the time we're long certain markets, short other markets. Every once in a while we have a short tilt and we have a long tilt, but it's a mix. And yeah, sure. I mean, if all on a certain day, every single market that we traded moved in such a crazy way that they all hit the stop at the same point in time, then yes, I will be losing my initial, or that whatever the risk amount is that I have on at that point in time in one sweep go. Is that possible? Theoretically, yes. Is it likely? I'd say no.
What say you, Jerry?
Yeah, just on the last one, I think sometimes those numbers, they do look a little daunting and large. My response, though, is that I've never had a position on in all the markets at the same time. And the positions are put on over the last years, months, and some of them are very old, 1 or 2 years and on up to yesterday, so there's a built-in profit in some of those trades. So it's not quite as bad. The equation he gave us, which I don't even know if you mentioned, it was incorrect because you have to divide it by 3. You multiply by 3, you have to divide. We don't risk 50 basis points on all 3 systems. think is what he was sort of saying. But
Yeah.
yeah. So, anyways, it's a complicated subject. It's hard to get it down to a sound bite. But it's it is one of those things where when you look at your, I know some people like to look at what happens if all my positions hit my stop loss. That can, that doesn't look that great all the time. It's good that clients don't see that. But thankfully we do have diversification. And at the very end, I would say to George, if you have the perfect system, the perfect plan, you should always, it needs a backup. It needs something that it's going to need help at some point in your life. And that is just to reduce your risk, take some positions off. If the vol is getting too high, if the losses are getting crazy, and you do see a lot of risk out there and the markets are crazy. I've seen times like that. Just trade small for a while. Get rid of half your positions. Get rid of a third of your positions. And George accused me of, this sounds like it's overriding. Yes, I'm okay with overriding for risk control reasons infrequently. Don't trade with large leverage with -4% and +4% P&Ls per day. You're not going to be quick enough and deft enough to make these cutbacks. That's crazy. So trade small, risk 25 basis points per trade or 50 basis points per trade. And then maybe that could be too much sometimes. So cut that back, but just do it infrequently. You're not doing a system trade when you do a money management trade, but you may have to do a money management trade to ultimately preserve the capital, and you have a positive game, you have a positive system, so you'll eventually win. Minimum boldness. So that is the rule. It is sort of overriding, I do think, but it's a good override. But you would want to do it infrequently. On the first question, I questioned George on the question, and he wrote back with a quote. The quote that he wrote back, I guess it's Dalio saying, "I saw that with 15 to 20 good and uncorrelated return streams, I could dramatically reduce my risk without reducing my expected returns." It's another very long discussion to do it justice, but that's one idea that doesn't apply to trend following, which reducing our expected returns due to diversification is not applicable to trend following. All the trades have the same expectation, and we build a portfolio just based upon the diversification and trying to limit risk. That's the way I do it. And then going forward, I expect the trades to make about the same amount of money, over a given amount of time. So there's no opportunity cost, or there's nothing to worry about reducing expected returns by diversifying. And then as Moritz said, it starts to decline. Well, what does that even mean? I mean, it starts to decline. LeBron, 30 years old, males start declining in their athletic ability. But LeBron's 35. He's still the best, but he has declined. So what? It doesn't really say very much. And it's not ever going to hurt your performance to add markets and improve your diversification. And the trend following kind of can only increase the diversification in the markets. It cannot reduce it. So there have been times where, at least twice in history, that trading heating oil had doubled in price. Like I said in an earlier podcast, I made 30% in heating oil in 1990, and I made 30% for the year, or 93. And silver has doubled. In 87, silver doubled in price, and gold went up a little. So, and then they went back to being 90% correlated. So correlation is one thing, and then dispersion of results is another. I tweeted an article on dispersion of results compared to correlations, which is interesting read. We'll hopefully get to next week.
Yeah, that would be great.
LeBron is 35. Tom Brady's 41.
Yeah.
They've dropped off, but so what?
You want to have him off your team? Think about it.
A great question, George. I mean, I think my summary, we've already talked a lot about it. My summary is that I think I do remember that quote from Ray Dalio. I think I heard about it in Tony Robbins' book, Money Master the Game, and his interview. For me, I think Dalio is referring to, return drivers. We would probably, we do talk about lots of different markets, but I think, again, given normal correlations, we would probably say, well, the three or four energy markets is kind of one return driver, even though we want to keep trading all of them, because one of them might just go and have a mega trend at some point. And so I think that's where there's a little bit of distinction there. And then the other thing I think is also very important, as Jerry said, I mean, when we talk about 50 basis points, et cetera, that's for the whole market, not for each individual model. But I think also what you need to take into account in the question about, can we end up losing 75% in a day or whatever? I mean, as Jerry said, and as Moritz said, we have, a different, different stops, trailing stops, and open risk is not the same. And therefore, it seems to me very unlikely that would happen, except, and this is important, except that you would have seen it not with trend followers, but you've certainly seen it with other strategies, what I would define as generally short vol strategies, where they do, see sometimes, lose 75 or even 100% in a day. We saw that in February of last year, but we should not confuse that with what trend followers are doing for sure. Anyways, I think we've talked about it, George, and thanks for the question. Francois has a completely different question this week. Thanks for that. Here we go. Instead of talking about differences between trend following, momentum, time series, and cross-sectional data, let's pretend we are watching a horse race. Okay. The race is comprised of 40 horses. During the race, a trend follower would compare the position of each horse between now and, let's say, 30 seconds ago, look back period. From there, the trend follower would calculate the speed of the 40 horses and allocate as follows. Long horses that move forward, positive speed, and short horses that move backward, negative speed. At this point, only the sign of the speed is taken into consideration for the capital allocation, not the actual speed. Including the actual speed would allow the trend follower to rank the horses, and why not? Going long, the fastest 15 horses, and short, the slowest, quote unquote, bracket going backward. 15 horses while avoiding the 10 sleepy horses in the middle. I hope I read this properly. It's a bit tricky to read, but it's an interesting analogy. The question, is it a fair statement to say that trend followers are interested in the sign of the speed only, not the actual speed? Okay, I hope we can understand fully that question and give you some thought. Let me start out on this one. So, and I'm not sure whether it's exactly how you thought about the question, Francois, but we look at each market and we try and define the signal strength. So which markets we want to, back with more risk, and which market we want to have smaller risk in. And because we use multiple subsystems within each model, basically to get, as Jerry also and Moritz have talked about, we want to have many confirmations in the same direction in order to build the confidence in the signal, the strength of the signal. So clearly, if you get, if you have a market that accelerates in momentum, it is more likely that that's going to give us a higher confidence, a stronger signal. So in that sense, you could say, yeah, maybe we give the faster horses, in this case, the more buoyant and momentum strong type markets, more risk. But I also think, again, I'm trying to visualize this as I answer your question. I also think you can have a situation where essentially then this momentum, falls off. But it doesn't necessarily mean initially that you're going to reduce your position. It doesn't necessarily mean that some of these sub-models or subsystems are suddenly saying, well, we shouldn't be long anymore, let's go neutral, and therefore the signal strength starts to fall. So it depends on how you define your model. Is it only looking at the price? Well, I actually think you could have a plateau of a price after a certain trend, and actually your momentum or your position would be the same. So even though they're all suddenly taking it slowly, it's still in a strong trend, quote unquote strong trend. But I also think some managers, and we certainly look at that as well on our side, would look at the signal strength itself to see if there's any information as to whether the signal itself, meaning the momentum, is slowing down. So I can't say for sure, in terms of answering your question using your analogy, but all I can say is that I think that there is certain situation where speed, certainly of the trend, is important. But I also think there are certain periods where not necessarily it's the speed of the trend or the how the momentum develops that determines fully whether to change your position size or not. Anyway, that was my attempt to answer your question, Francois. Jerry, Moritz, how would you?
Slightly different on that one. I just to start, I would say that if I choose to trade 3 or 4 different trend following systems, I wouldn't sort of classify that as anything other than a tactical approach of diversifying my entries and exits. It's not an attempt to measure strength of trend. Yes, my position doubled today in a certain market, but it's just system 2 kicking in that has a different parameter. Nothing big going on here. They're all traded independently. It's not a signal to me that the trade has either system 1 that's been in for a while and system 2 now has more expectation or a better trade. It's just a tactical approach to diversify my entries and exits. But frankly, I think it's better to just have entry criteria that is a go or no go. So if it hits the breakout that I need and another filter-ish type thing, parentheses, that doesn't prevent me from getting in the trade eventually, then I'm in. I'm in, and it's okay. I'm not trying to grade the trend. I'm not trying to add position based upon strength. I have my entry criteria. They got met. Then all of the trades are equal to me. And frankly, you have to do that because of sample size. You have to figure out a way to have the system generate in a back test thousands of trades, and they all have to be the same. In the sense that they entered an exit with the same criteria.
Yeah, no, I like that answer as well. Definitely. Moritz, anything you want to add or?
I don't think I've got much to add to that.
Okay, well then you can go first on the final question of today, which is from Samuel. Thanks, Samuel, for your question. Completely different area, but also relevant to what we do. And the question goes like this: can you discuss how any of you approach the process of rolling positions forward? Is this a mechanical or strategic system that, like the trade rules themselves, is it different? Is it different if the expected roll yield on an asset is negative/positive, etc.? In addition, can each of you share your favorite resource for staying abreast to systematic investment? I thought you were listening to it, Samuel, actually. But anyways, and trend following media, your favorite journals, subscriptions, authors. This can be gathered from tweets or such, but it would be nice to hear what all of you value in the finance industry and why. Moritz, over to you.
So I go first on the last. Okay. As far as the rolling is concerned, it is systematized. Now, I roll markets in different ways. Certain markets, if they're physically delivered, they have a first notice date, examining their volume and open interest distribution historically. If you do that, you will see that there's kind of like a roll period when the market starts moving from one contract to another. There are markets where, even if a contract is listed, that contract is kind of like dormant. It's not very liquid. It's not traded that much. So you skip that and you go into another contract. I have in some of the markets I trade. So, for instance, crude oil. To give the example, crude oil. There's a monthly expiry there. There's an expiration month every month, January to December. I'm not trading all of the month. Some of the month I do skip. That saves me roll cost. And as far as my analysis goes, it doesn't cost me anything. At least historically, it doesn't cost me anything in terms of returns. And, in fact, it does improve my system. So I'm doing that. But to make a long story short, it is systematized. It is a function of the first notice date or the last trade date of the contract. And then I just do the roll. It is not a function of the roll yield or whether a market is in contango or backwardation. So, I'm just not taking that into account for that trend following system.
Great. What about your favorite resources?
Yeah, the favorite resources. Let me think about that. Favorite resources. Books. Speaking to people. I don't know. I don't have the favorite resource that I could name. It is essentially reading a lot of books on trading, speaking to people who've done it. It's very important. Finding good mentors, getting their view of the markets and how they cope with them, how they've developed their systems. Of course, things like Twitter, they're enjoyable. There are some good things on there. There are some bad things on there. Shouldn't be your only resource. Read the white papers, the research papers, which are published on trend following, on managed futures in the journals. There you go. I mean, I think once you start digging into one source, you'll find references to, over time, you'll find references to all of the other sources. And it's a pretty broad field. And I like being open-minded. So with my, if you want to call it research or interest in the markets, it is not just trend following. I think that would be too narrow and blind-sided. It is the strategy that I choose, the strategy that I prefer, it's the strategy that I love. But I do want to read about other strategies. I do want to read about other managers, how other people go about the markets, learn from their failures, learn from their, their successes, and see if any of those stories or the way they look at markets. We've just mentioned Seth Klarman at the beginning of that podcast. He's a value investor. He's not, a trend follower per se, but, reading about him, I don't want to say just because I'm trading trend following, I don't want to read about him. I definitely want to read about him. I want to read about Ray Dalio and, all of those guys, just to, have the broadest possible spectrum of ideas. Never stop doing that. Never stop learning. I think you really have to do it to be up to the game.
What about you, Jerry?
Yes, I liked Moritz's answer. It's perfect. I think that's a great way to do it. The only thing I could add is there will be some opportunities I've seen over time, especially if you're a smaller trader, to trend follow the spread. So hold on. It's getting close. It's first notice day soon, but in the volume and liquidity has switched, but the spread is going in our favor. Let's hold on if we can, as long as we can. And then the opposite is nothing's really going on. It just looks like every day we're losing to the spread. We're losing, and we need to look at the trend of that and go ahead and maybe try to go a couple days early or something along those lines. But I have made extra money by some of the commodities, like nat gas, heating oil, the grains, by speeding up and slowing down the spread based on the trend of the spread. And then, of course, I do a lot of reading throughout the day, a lot of Twitter stuff throughout the day, and I use Google Alerts a lot. I'm interested in certain topics and people and traders, and I have Google Alerts for 300 or 400 different subjects and people that I want to follow. The obvious ones that I'm interested in. Ritholtz email each day with some headlines on that. Abnormal returns, probably the best source for headlines and what's going on in the markets and good writing. Those links are pretty indispensable to me. Theo's Alternative Intelligence, Peter Lacalamida, very good, especially from the hedge fund alternative point of view. So yeah, it's a lot of good stuff out there, and it's a lot of overlap and a lot of people quoting the same people. So finding the right people on Twitter, if you're interested in trend and systematic and algorithms, you'll pretty quickly find a lot, way more to read than you could probably have time for.
No, very true. To answer your question, Samuel, just in a little bit of different ways, I would say there's a difference from being a small shop and a big shop. I think that within our shop, we have, some very, very experienced traders who, have been trading the markets for, 20, 30, 40 years. And so they, of course, will have their own way of determining the ideal roll point. But for many of the things that I've done in my career, where it's also been starting at a much, much smaller scale, I actually think that this is not a plug for them. I mean, they're not supporting our podcast, but I think that it's worth mentioning, and that is the data source called CSI. I mean, CSI is a reasonably inexpensive data source, gives you great, end of day data. And in CSI, you can pretty much determine what kind of system you want to use for your roles. And as Moritz mentioned, I mean, and for many years, I've been involved in businesses where we basically just set the roles to be kind of more or less the same date, X number of days prior to the next or to the contract expiry, et cetera, et cetera. So nothing too clever, but it works. And yeah, I mean, as Jerry mentioned, you could certainly earn a little bit extra from focusing on that. But I don't know that certainly in the beginning that it makes a big difference. And therefore, having simple rules for doing that side of your trading is probably a perfectly fine idea. When it comes to resources, I agree with Jerry and Moritz, except that I probably don't have so much time to read stuff during the day. So a lot of my inspiration really comes from the podcasting side, perhaps not unsurprising, but there's a few podcasts that I really like. I think generally speaking, listening to traders / managers is probably what I enjoy the most. Which is partly why I started the Top Traders Unplugged, because I wanted someone like Jerry to come on and share his story and for other people to learn from it. I think there is so many great things we can learn. And of course, my inspiration to a certain extent came from the Market Wizards books written by Schwager. And because I learned a lot from just reading about how these managers had built their businesses, their view on trading, et cetera, et cetera. So I wanted to do it digitally, and the interview audio style for me was better because I have time when I drive or if I travel to listen to things, and so it's an easier format for me. So some of the podcasts that I enjoy, I mean, I guess I started out like many other people listening to people like Michael Covell. Certainly the trader part of the podcast, not necessarily all the episodes, but things where it's a manager being interviewed. Of course, there are other podcasts like Chat with Traders. I don't listen to that myself so much, but Aaron actually reached out to me after I had started my podcast and asked me, and I think he's done a great job in sharing a lot of content. So well done for that. More recently, there's a couple of other podcasts that I have found that I really like, and they give me, like Moritz was saying. I mean, when a great manager comes on a podcast and starts talking, I think even if it's a strategy that's not directly related to trend following, I think you can learn a lot and take something away. And the constant learning is important. I like Patrick O'Shaughnessy's podcast. something I do try, and certainly if I pick the right episodes. I listen sometimes to the Investors podcast. I like what Stieg and Preston are doing on that. I also like Ted Seibert podcast. I think he has some great interviews as well, both maybe more on the investor side, which of course is very relevant for me in where I sit, but also on psychology and other things. So I think there's a lot of gems out there, but of course you have to prioritize. Most likely you can't listen to all of them. But I do think, and then of course, combined with the things that Jerry and Moritz are sharing as well, I think there's a lot of good stuff to dig into. But a good question for sure to find out. I think that wraps up. I mean, we're already 1.5 hours into our conversation this week, so this is a long one, but we do appreciate the questions. So let me just quickly run through performance. This is as of Thursday, so I think Friday was an okay day, generally speaking. That's going to be my guess. So just be aware that this data may be a little bit better than what I'm quoting. The BTOP 50 index, pretty much flat for the month, and down 1.73 for the year. SocGen CT index up 0.25% for the month, down 1.63%. SocGen Trend Index up 0.62% for the month, down 2.61% for the year, and the SocGen the SocGen Short-Term Traders Index down 0.57 for the month, and down 2.25 for the year, and then the Bridge Alternative Index up 0.67 for the month and down 3.41 for the year. A lot of talking, a lot of questions, a lot of thoughts today. Anything you want to add before we wrap up?
Other than happy trading? No.
What about you, Jerry? Anything on your...
No, I think we got a lot left over, so
yeah,
a hit start for next week.
Yes.
Okay, cool. Excellent. So on that note, let's wrap up this week's conversation. We hope that you enjoyed it. Keep your questions coming. Just send them to info@toptradersunplugged.com or send us a tweet. And if you want to give something back to us, all we ask for is that you share this podcast with one like-minded friend. From Jerry, Moritz, and me, thank you so much for listening, and we look forward to being back with you on the next episode of The Systematic Investor. In the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.